Hi, good evening, ladies and gentlemen. Welcome to the FSM 2020 Mid-Year Outlook. Thank you for taking your time to join us here today in this webinar. The first half of 2020 has been quite a tumultuous one. As we begin the year, the world has been faced with an unexpected and untimely COVID pandemic, just as the US-China trade conflict of last year was dying down. More importantly, the COVID crisis has also negatively affected the global financial market. With global equities plunging close to 30% in March, when the global economy hot to a standstill amidst the widespread lockdown. However, just within a short span of 2 months, we also witnessed a massive V-shaped recovery in global equities from March low. So much so that some equities and markets are now trading near their all-time high. Looking ahead into the second half of this year, we think that the global markets are now at the inflection point, and what lies ahead could be the new normal investment environment. For asset classes, not only does this mean that there will be plenty of exciting opportunity, but also rising risk coming from, say, for example, the second wave of the COVID pandemic, as well as the US-China trade war. So in this webinar, we have with us 3 research analysts: Colin from the Macro Research team, Sean from the Unit Trust team, and Weiren from the Stocks and ETF team, who will share with us some of their thoughts on the market, as well as some of the high conviction ideas for the second half of 2020 and beyond. Without much further ado, I'll pass the time to Colin, who will present our macro outlook. Colin, please.
Hi, good evening, guys. So it's great to be here to present the mid-year outlook. So we are focusing specifically on the opportunities as well as strategies for the second half of the year. So I'll begin by doing a short recap on the performance for the first half of the year. So first half of the year, as you can see from the charts on the right-hand side, both the global equity as well as global fixed income charts, we see quite a strong sort of V-shaped rebound in global capital markets. So that's after a tumultuous first half of the year where both the global fixed income as well as the equities market plunged more than 20 and 30% respectively. So that is being followed by quite a meteoric rally from the depth of March low. And all that happened within a span of 2 months, which is at the record pace if we look across the history. And overall, we would like to note that the top performers for the equity markets remain the internet stocks that's represented by digital economy and the pink line on the top, as well as the Chinese equities. And whereas for the fixed income markets, the top performers are the US Treasuries as well as the US IG. And investors generally have regained their confidence in markets, and that's largely due to a massive fiscal stimulus as well as the central bank support. And hence this kind of roll over and paved the way for a rotation to cyclical and as well as value, small cap and higher risk assets. So in this outlook, we'll try to touch on some of these subjects as well as provide more color on what has happened as well as what are opportunities lying ahead. So firstly, I'll touch on the key themes in the second half of the year, and what this will do is that this will shape the investment landscape moving ahead. So the first theme that we see is the global economic recovery, and we believe that it will take time but accelerate in 2021. And the shape of the recovery, which is highly debated, and we believe that there is a checkmark shape recovery. So for the first V-shape of the checkmark, the drawdown itself, the maximum economic contraction, which we believe is somewhere around March to May, is likely to be behind us. So whereas the recovery process will take a bit longer, will likely drag until the next year, and that is because post-reopening measures such as your safe distancing, etc., and unemployment rate, persistent second wave, and all this would dampen the recovery in the second half of the year. However, as we can see from the chart on the right-hand side, the Asian economies itself, the growth of the Asian economies will return to pre-COVID levels in 2021. That is outpacing their peers, which are the larger economies stemming from UK, US, as well as the Eurozone. And overall, this leads me to my second point, which is the second theme. We believe the second half of the year will be a race to recovery. So the speed of recovery is definitely key to watch. So economies that demonstrate a positive data surprise, positive revision, and a robust recovery will see greater price momentum. And conversely, economies that disappoint will run the risk of repricing lower, and there is a high possibility given the current level of valuations. So that brings me to my second theme, which is the US dollar weakening against many other currency. So we believe that the dollar is unlikely to show outright weakness, but face more negative pressure in the second half of the year. So three factors culminate in this argument. So firstly is the recovery in growth versus the rest of the world. So the chart on the right shows that the dollar tends to weaken when US growth is relatively slower to the rest of the world. And secondly, there is the easing of dollar demand. So that comes from the reopening of a supply chain as well as the trade, global trade. And lastly, the money printing by the Fed itself is increasing the money supply out there, or increasing the US dollar supply out there, and that has put tremendous downwards pressure in the dollar. So the chart below shows the broad real trade weighted dollar index, and across history you can see that every time during QE there's heavy downwards pressure, and the one time we see QT, which is after 2018, we see upwards pressure for the dollar. And overall, what this means for equity markets is that the weaker dollar is generally positive for EM equities as well as EM currencies, and this is via the easing of financial conditions, supporting commodity prices as well as mitigating the dollar debt servicing stress. So moving ahead to the main risk to watch for the second half of the year, we believe the number one key risk is still the persistent COVID-19 case count, the second wave, and as well as the further shutdowns due to the second wave. So if you look across the globe, case count itself is rising quite rapidly, particularly in EM such as Latin America as well as the Middle East. And we believe that this may lead to rolling shutdown for cities as well as a delay in full reopening process. And for companies themselves, some are willing to reopen. So the example would be Apple, especially in the US, that they are unwilling to reopen in states where there's a rising COVID case count. And overall, we believe that should the waves of shutdown resume again, optimism and recovery will be further impeded, and therefore markets will have to reprice lower. So the next risk that we see is that it is closely related to the US general election, as well as the related risk that it brings forth. And overall, US equities historically has been more volatile before a competitive election. And we believe this election itself will be relatively competitive. So the chart on top shows the popularity of the presidential candidate that is based on the aggregate polling data. As you can see, Joe Biden has the popularity of Joe Biden has risen quite significantly over the past 2 months. And overall, despite the election being held in the US, we believe that the global risk sentiments may be affected. And this also brings about a trigger point for other risks. So risks such as the revival of trade tension as well as a potential fiscal cliff. And what that means is a potential for taxes to be raised in order to cover the deficit and measures, extreme measures such as that. And overall, the other risk that we see is more immediate. So that is the weaning off of policy stimulus. And we believe that overall political pressure around the world, as well as improving economic data, may threaten the continuation of many policy supports. And markets will definitely react negatively if these programs are not rolled over, as they have become quite a bedrock for investors' optimism. So the chart below shows how Fed's balance sheet expansion actually slowed down in the month of June, and therefore liquidity flowing into the equity markets kind of slowed down, and you can see that has an effect on equity markets. So moving straight into the global equities, so we prepared two different view sets. So firstly, we're talking on the tactical near-term view and moving on to the longer-term horizon. So technically in the near term for the second half of the year, we believe that the near-term headwinds can lift markets higher. So this revolves around three main tailwinds that we see. And so these are the optimism and risk on appetite, elevated levels of liquidity, as well as an inflow from retail and institutional investors. So all these factors are actually present in March and April, and these are being rolled over to the second half of the year. So my chart on top, you can see the change in central bank balance sheet. So that highlights the major central banks for US, EU, Japan, as well as the UK. So as you can see, since the month of June and May, you see a huge balance sheet expansion from all these major central banks, and that has actually elevated levels of liquidity in the markets. So my chart below shows the total money market funds the total assets of the money market funds as of June. So we can see that the levels there actually exceeded levels in 2008. So investors are sitting on high level of money market funds or high level of spare cash that's being able or will be able to be deployed relatively quickly, and therefore we do see that translating to potential inflow from retail as well as institutional investors. But at the same time, we realize on the other side, risks are also actually mounting. So, for example, some of the risks like I mentioned, U.S. election, trade tension, the second wave rolling shutdown, as well as the slowing of stimulus measures. So overall, on a risk return basis, we find that there's more risk per unit reward compared to March as well as April, and therefore selective buying in the second half of the year is key as opposed to broad-based buying of equities. So when investors think about buying opportunities, we caution against buying all the laggards and buying whatever that has been beaten down badly. So we believe that investors should definitely exercise some caution moving into the second half of the year. So from a longer-term strategical perspective, 1 or 2 years out, we believe that growth itself needs time to rebound back to pre-COVID levels, but we expect a move to cyclical expansion in FY 2021, which is the next year. So on the chart on top, you can see there's an orange highlight which shows the phase that we should be moving into for the next year. And if you look at the other side of stuff, which is the inflation side, we believe reflation should follow the next year due to the amount of money printing and the gradual rebuilding of lost demand. So overall, if you look across history, you'll find that decent level of inflation combined with economic expansion is definitely a potent positive for equity markets, and therefore the longer-term outlook itself is more constructive. So for those that wondering about global earnings growth as well as global valuation, we believe that global earnings itself will be bad this year, but the rebound next year should be quite robust. But the thing to note here is that the speed of the earnings recovery may vary across markets. So as you can see from the chart on top, you'll find that earnings for most Asian markets will return to pre-COVID level somewhere around next year, whereas many of them, like the emerging markets, will only return in the following year. And so what this means for valuation is that many markets are actually markets are trading at elevated levels that's due to the rapid degradation in earnings this year. And you can see that by comparing the bar, which is the current PE valuation, against the pink dot, which is before the outbreak. And you'll find that we are focusing on the fiscal 2021's earnings as well as valuation level, and it gives us a more normalized basis for comparison, as well as to take into account the rebound from some of the markets, the rebound in earnings. And overall, you'll find that the Asian markets are more attractive based on the valuation level. So you can see that a lot of Asian markets lie on the right-hand side of the chart. So moving into some of the pockets of opportunities and talking about the strategies for the different regions. First, I'll touch on the US. So we have become more positive on the US, and that is because we believe the excess liquidity from balance sheet expansion supports equity prices, and the Fed's implicit support is actually positive for investor sentiment. So if you can take a look at the chart on top, you'll find that the Fed's balance sheet expansion, or it translates to excess liquidity, which drives further valuation expansion. So we believe that the excess liquidity will remain in the system because of the pledge and support by the Fed, and them officially saying that towards the end of the year or two, economic data becomes better, the QE will stay. And overall, we believe that the US equity should perform better than peers if there's any further drawdown, and that's due to strong Fed support as well as deep pocket fiscal stimulus. And if you were to look at from a bottom-up basis for US equities, there's a lot of champion companies, especially from the IT side, from the tech side, as well as from the consumer discretionary side. And all in all, we believe that even in a drawdown in the next half of the year, we find that these are the companies that will benefit, and therefore it benefits in a broader US market. And overall, we believe that US equities itself are seen to be relatively more attractive compared to its peers, and therefore there is no alternative. TINA narrative is strong between investors. So if you look at the chart below, you'll see the cumulative flow into the global equity ETFs as a percentage of the AUM. over the past 2 to 3 years, you'll find that the US itself, especially after the COVID crisis, you'll find a pickup in inflows in US ETF, and that is quite favorable compared to the other regions such as the EM, Europe, or even Japan, which sees an outflow in the ETFs. So that itself reinforces there's no alternative narrative between US as well as other equity markets. So the main risk that we see that will happen to the US market as well as the economy is that the rolling shutdowns may occur due to an uncontrollable second wave, and also that the US election and uncertainty will bring about the revival of the US-China trade dispute. So moving on to Europe, which is another region we have turned positive on. So we believe that there is a low possibility of a serious second wave after a successful reopening. So the chart on top shows how Europe is able to control and able to successfully lower its case count on a 7-day moving average basis versus its peers. And because of a low possibility of a second wave, the economic activities in Europe are actually rebounding faster than expected. And therefore, we believe earnings revision might actually have bottomed. So the chart below shows the manufacturing PMI as well as service PMI compared across major economies. So I would like to draw your attention to Europe, which is the black line. You can see it's a huge drop for Europe, indicating that the damage that Europe suffered is actually quite large. But what we are looking at is the rebound, the speed of rebound. Like I said at the start of my slides, the speed of rebound is key to watch. And we find that Europe has a relatively faster speed of rebound as well as of a higher magnitude. And overall, we find that the policy response for Europe remains quite robust, and the deal in the EU Recovery Fund could be a game changer and could be a long-term potential positive catalyst. And overall, if you look at the case of the European equities, we'll find that positive catalysts are actually lining up, but they are not fully priced in yet, and therefore we believe the scope for positive earnings as well as the GDP growth revision are actually increasing, and so there's a big plus sign. And the main risk to Europe's European equities case is that the EU Recovery Fund may not materialize, and that leads to a prolonged economic recovery. And the last area that we'd like to touch on is Asia. So the topics for Asia remains China, Hong Kong, South Korea, Taiwan, as well as Indonesia. So we like Asia because of its success in combating the COVID-19, and therefore it minimized the economic blow and allowed for faster policy supports. And therefore you find that earnings as well as GDP recover faster to pre-COVID level, more so than its peers. And overall, the other good thing that we like is that we see that global trade has actually picked up, and this will significantly benefit trade-reliant Asian economies. So the chart on top, you can see the comparison of the Baltic Dry Index, Germany exports as well as South Korea exports. So all these are leading indicators for the global trade, and see quite a strong pickup in the month of June. And to further this argument, we believe that the weakening dollar is actually positive for Asian emerging markets as well as Asian currencies. And we were to look at things from a flow basis, we'll find that capital flows in emerging Asia has begun to pick up quite rapidly. So the chart below shows the strong pickup in EM Asia capital flow into the equity market as well as bond markets. And with regards to that, we believe that there's still more room to grow, and therefore there's more impetus for Asian equities to go even higher. And overall, the main risk we see to the case of Asia is definitely the revival of the US-Sino trade dispute, which can compromise both global trade as well as China's recovery. All right, so now we'll move ahead into the global fixed income and the outlook we see for the second half of the year. So mainly the name of the game for this strategy is, we believe, to be having a fine balance between defensiveness as well as selective cyclical positioning. And we believe that defensive positioning, especially in the US Treasury as well as the IG bonds, are still important in the second half of the year, and that is due to the greater likelihood of event-driven risk. So I mentioned some of these risks earlier on in my slides. And overall, the yields for the higher quality segments are likely to remain range-bound for this year, and lower interest rates are also likely to remain prolonged for a longer period of time, so likely to be there for the next 1 to 2 years. So with that said, with yields for the higher quality segment being quite low, we see an importance in allocation in the higher yielding segment. But we do caution investors to be very selective for the high yield segment, because we have to balance the target to enhance total return without sacrificing or without forsaking too much of a risk management. And another thing we like about the higher yielding segment is that we see a couple of drivers materializing. So firstly is definitely the fiercer hunt for yield, and secondly is the risk on sentiment, and lastly is the bond carry demand. So my chart on the right side, you can see the spread across the different fixed income segment. You can see particularly the higher yielding segments having a greater spread, and especially over its historical average. So the next couple of slides, we're talking about some of the regions and some of the sub-segments in the fixed income markets, particularly the higher yielding segments, and how we view each of these segments. So firstly, I'll touch on the Asia high yield as well as the IG. So we still favor this area. We believe that there is still strong risk and reward prospect for these two segments. So valuation itself for both segments are actually cheap on both the absolute as well as the relative basis, and they are currently trading at around 50 basis point for the IG and 200 basis point for the high yield, and those are still wider than the longer term fair value. So from a fundamental perspective, we believe that the economic as well as the earnings recovery in Asia are supportive for fundamentals, particularly credit fundamentals for the higher yielding issuing companies. And overall, if you recall a couple of slides back, talk about capital flowing back into Asian bonds, and that itself are quite prevalent for the Asian high yield segment, and that is because of the higher yield that they offer, as well as the carry demand that they have. And if you were to look at the spreads itself, we find that the spreads for the high yield actually overprices the default risk for the Asian high yield market, and that is indicative of its attractive entry point right now. And if I were to draw your attention to the chart on top, you'll find what I plotted is the Asian high yield implied default rate from the spreads. So with a recovery rate, which is historical average of around 20%, as well as 0%, we'll find that the implied default rate for recovery rate of 20% is 9.3%. So that is actually more than Moody's forecasted default rate for this year, as well as the actual default rate during the trough of the GFC in 2009, which is at 9.1%. And we find that this itself is actually an overpriced and too high compared to the actual default rate, as well as the Moody forecasted default rate, and that implies a possibility for spreads to normalize, and this normalization of spreads will result in a capital appreciation over the nearer term. And overall, the risk to this segment itself, we believe, is the recovery of a US-Sino trade dispute, and that if that profoundly impacts trade as well as China's growth. So moving on to the second segment, which is the EM debt. So overall, we still see a decent risk to reward prospect for that. And we believe that valuations are still cheap on both an absolute as well as a relative basis. So EM debt itself is currently trading at more than 120 to 210 basis point wider than its longer term fair value. And so the chart on the right hand side, you can see the high yield spreads as well as sovereign spreads are both above the +1 standard deviation marking. And if we were to look at some of the macro drivers for fundamentals, we'll find that the US dollar weakness, like I said earlier in my slides, as well as the improvement in global trade are actually positive for the EM corporate as well as the sovereign. But the overall risk we see to this segment are that the commodity prices and as well as global growth being impaired by the possible revival of the trade dispute, and also for that the prolonged COVID-19 fight that would be draining on the EM's limited fiscal as well as monetary MOE, and that could possibly hold back growth for the EM sovereign as well as growth for the EM corporates. And finally, for the US high yield, we find that the risk reward actually declined since the end of March, but is on a relative basis is still decent. So we believe that the Fed's support for this sub-segment acts as a safety net as well as a support for demand. That demand has been, and that has actually fueled quite a number of issuance over the past couple of months. And also a plus sign for this sub-segment is the deeper pockets for fiscal stimulus, and that is being able to support corporate fundamental if it deteriorates further. And overall, we find that the current spread is around 6%, as shown from my chart on top. So that is slightly above, which is 40 to 50 basis point above its longer-term average, and despite falling from March 11%. And overall, the expected default rate for this subsegment is around 9%. So with the current spread, it is implying the current spread that is implying the default rate of similarly around 11%. And therefore, we see not as much room as compared to the Asian high yield for a normalization of the spreads should things get better for the US high yield. But overall, the risk to this segment remains to be that the consumer as well as the household being hit harder than expected. Should they be hit harder than expected, we see the US high yield have potentially more downgrades, especially coming from the consumer sectors, which is around 30% of the US high yield composition. And the chart below shows that there's a huge amount of downgrades over the past 2 to 3 months, especially after March. And we find that most of this downgrade actually comes from the higher yielding segments. So I'll proceed to my last slide, which is talking about the global asset allocation. So the allocation within the asset classes. So overall, we still prefer an overweight of equities over fixed income, but at the same time, we remain wary of the risk in the second half of the year. So if you look at one side of stuff, you look at the fixed income segment, you'll find that the lower for longer interest rate environment, as well as the spread compression, have actually reduced forward returns for the fixed income segments. So on the other hand, we'll find that lower rates and balance sheet expansion are actually supportive for equity asset prices, and there's looking further ahead. And we believe that the potential returns for equity are likely to be more attractive than fixed income in the coming macro environment. So overall, if you look at from a risk premium perspective, you'll find that risk premium for equities over fixed income have definitely fallen quite significantly, but still remaining at a decent level, around 4 to 5%. So if you can look at the table below, you'll find that our views are actually summarized in the table. So I would like to just quickly run through the table. So for the global equities portion, we'll find that we remain more positive on US, Europe, Asia, Japan, China, and we have turned less positive on Japan as well as the EMEA. But then we remain neutral on the Latin America as well as the digital economy. So for the global fixed income segment, we remain more positive on the Asian high yield as well as the EMD, and remain neutral US IG and as well as Asia IG, and we have turned less positive on the US high yield. So with that said, I want to highlight that these are positioning relative to the first half of the year, so the first half of 2020. And with that, I come to the end of my presentation, and now I should pass on to my colleague, which should take you guys through the best idea for the unit trust.
Thank you, Colin, for your for going through basically the macro outlook for the second half of the year. So my name is Sean, and I am an analyst with the Unit Trust Research team at FSM1. So today I'm just going to keep the structure of my presentation very simple. So I will have 3 ideas for you, and for every idea I'll provide 3 reasons as to why you should actually invest in this idea. So I think just to start things off, like my first idea for today is basically global comfortable bonds. So I think most of you will probably not be very familiar with this asset class. So not to worry, I will run you through quickly as to what comfortable bonds are and why consider that. So I think just to allude to what Colin has mentioned earlier. So essentially what he's saying is that based on his global equities outlook, I think right now he's just saying that there's an increase in likelihood for tail risk events to happen. So tail risks are basically within a probability distribution, right? They represent the most extreme outcomes. So at this point in time, we believe that fat tail risks basically exist, where it's possible for asset prices to swing wildly in either in either the left side, either positive or negative. And some of the reasons I think he has pointed out is basically with what the Fed is doing right now, excess liquidity. There's a lot of excess liquidity out in the system, and I think he also pointed out the risks with regards to any potential lockdowns that could happen, and this could actually lead down to further insolvencies down the road, and therefore it basically when you think about the risk out there, is like it could swing wildly to the positive, and it could also swing wildly to the negative. And so this chart basically summarizes, I think, what we are looking at. So normally, I think in a normal market environment, we would see something more similar to the blue line, which is more peaked towards like we don't see a lot of volatility. But I think right now we are somewhat closer to the orange distribution, where I think that there's more, where the likelihood of actually greater positive returns and greater negative returns are actually more that is actually more likely now. So I guess the question is how can we somewhat mitigate the impact of fat tail risk? How can we prevent ourselves from actually incurring too much losses and also giving up on the potential gains that that could be out there? So again, we think that the global convertible bond is actually one product that can actually allow investors to actually obtain an asymmetric investment profile. So just to run you through what convertible bonds are, so they're essentially straight bonds that have an equity call option embedded within them. So this call option basically allows the bondholder to convert the bond into common equities when the equity price of the underlying has risen. And also, I think depending on the bond features or the prevailing market conditions, this convertible bond may behave more like a bond or more like a stock. And this graph that I've shown over here basically summarizes how it reacts. So if you look at the black line, which basically tells you what the sensitivity of the bond price is to the underlying equity price, right? Actually, as you can see, as the equity prices go up, the bond becomes more sensitive to the underlying change in equity price, and past a certain point, it begins to act more like a equity. And as you can see, there's like this brown or grayish line, which is the bond floor. So generally speaking, convertible bonds, right, their value tends to be supported by the fact that they are actually bonds, corporate bonds. And they receive actually regular income payments. It's only when a credit event is likely to happen, then the convertible bond price will actually be negatively affected. But otherwise, the prices of convertible bonds tend to be supported because of its bond feature. So let's just run through quickly about some features about the product. So the first reason I think why you should actually consider this convertible bond fund is because, number one, we are in a fairly volatile environment. So if you look at what drives the price of a convertible bond, basically it's aside from the fact that it's a bond, its value also is derived from options. So options are affected by 4 factors, right? So number one, what's the likelihood of it expiring at the money? The time to expiry, what's the volatility of the option, and lastly, the interest rate volatility. And I think based on what I think Colin has shared, the likelihood of increasing market volatility is there, and also given the potential for a right tail risk event to happen, we think that the environment is actually quite ripe for convertible bonds to flourish and perform well. So if you look at the chart on the left, it basically shows you how the fund performs relative to other broad asset classes. And as you can see, when volatility is elevated, which is denoted as above 20 for the VIX, you can see that actually this bond fund basically outperforms all of your fixed income segments. And we think that given the likelihood for tail risk events, this fund basically gives you the best of both worlds of what bonds can offer you and what equities can offer you. And number two, the second reason is basically this fund has a strong historical track record, because I think this is generally quite important, especially when you want to invest in an actively managed fund. So since 2012, since its inception, it has delivered a cumulative return of about 100%. So and at this point in time, I think it's up to 20% year to date, despite this massive drawdown that equity markets have experienced. I think the S&P, for example, is probably not back to its original value since the start of the year. So you can see like how this fund actually provides you this asymmetric profile. And then secondly, one thing to note is that in terms of performance, you can actually view this fund's performance as something that's in between a high yield bond fund and also a global equity fund. And performance is one thing, right? Because we also have to look at the amount of risk that it actually takes to generate all these returns. So as you can see from the table at the bottom, right, you look at the circle area, the Sharpe ratio, the Sortino ratio. So at the end of the day, these are just basically risk-adjusted ratios. So the higher these ratios are, the more risk efficient the fund is in terms of generating returns. And as you can see, this fund actually, when you compare it to equities, bonds, treasuries, corporates, high yield, or even a balanced portfolio, this fund is actually able to provide this very attractive risk-adjusted returns. And when you look at what sort of drawdown they've experienced since, during the March drawdowns, it's only about 18%. You know, if you compare it to equities, about 30%. If you look at high yield bond funds, it's about 22%. So this fund, we believe, is actually is in a very sweet spot in terms of risk and return. And thirdly, I think another reason why you should potentially consider this fund adding it to your portfolio is because we believe it serves as a source of diversification. So I think generally speaking, when we talk about diversification, we want something that's low or imperfect to actually help us reduce overall risk in one's portfolio. So I think as you can see from this chart, the fund is generally more correlated with global equities, and that's also because of its equity exposure that it has via options. But I think from what we have observed over the past 5 years on average, the fund tends to have a beta of 0.7, which means that for every 1% rise in global equities, you can generally expect about a 0.7% increase or decrease in the fund's performance. And I think when you want to look at it from a perspective of diversification, right, we believe that, you know, this fund can actually help to balance the need to stay invested versus, you know, reducing your risk exposure to broad equities, especially if you believe that, let's say, markets are too overpriced right now and you don't really want to take that too much risk. We believe that this can actually be pretty much a good proxy for that, for gaining exposure to global equities. So the second idea I want to move on to is basically Greater China. And as you may have gathered from Colin's presentation earlier, it's one of the areas that we're actually fairly positive on. And the main reason why we actually like Greater China is because we believe that the recovery for this region is ahead of the rest of the world, right? So I think the main reasons to like is basically we are seeing a rebound in global trade activity, and these are basically one of the largest exporters in the world. And secondly, a weakening dollar is often good for trade as well as emerging markets, which Greater China is part of. And I think most importantly, I think this region has actually seen quite successful COVID-19 containment policies, which has allowed them to actually reopen their economies more effectively and without any further risk of major shutdowns. And also, we believe that this region is expected to recover their earnings and GDP growth faster than Western developed economies. And we think that all in all, the UBS equity fund Greater China is actually one good way to actually express this view, because this fund is able to invest in China, Taiwan, and China A and China H shares. So I think one chart to actually bring your attention to is basically this, because I think for FSM, we always look at things from an earnings growth perspective. And I think what we have seen over the past few months is basically an expansion in credit growth in China. And often, we often see this very strong relationship between credit growth and subsequent EPS growth moving forward. And we believe that like this recent shift in Chinese equities in terms of the returns over the past 1 to 2 months is actually a reflection of market participants actually warming to the idea that okay, things are getting better, and perhaps with this expansion in credit growth, we could see earnings growth improve for not just China but also Taiwan. So the China EPS is actually MSCI China, which basically has some exposure to A-share, H-shares, and also some ADRs. Whereas you look at the orange line, it's basically pretty much the same, except that they include Taiwan into the mix. So the MSCI Golden Dragon Index is actually just a very fancy way of saying, okay, it includes China and Taiwan. And so let's just move on to some of the product features and characteristics that we like about this fund. So number one, I think we like this fund because it's positioned for long-term secular growers. And we generally agree that with what the fund manager is doing in terms of how it's positioning for long-term trends, it's relating to rising consumption and premiumization in the habits of Chinese consumers. Number two, I think China will continue to urbanize, and that means that people are moving from villages to cities, and overall, we think that the people are just going to become richer over the long term. They're going to grow wealthier. And number three, I think China is also seeing an aging population, and we think that that actually presents new opportunities in terms of healthcare. And also lastly, innovation. I think we have seen quite a bit of innovation coming up from China over the past few years, that they are starting to champion a lot of global tech phenomena, and we basically agree with what the fund manager is doing, and we think that they have their head in the right position, in the right spot in terms of positioning the portfolio for the long term. So what they do is basically they look for strategic industries, and within these strategic industries, they look for leading companies that will benefit from China's structural growth and transition towards a services-led economy. And I think what we like about this fund is basically is that it's not afraid to be overweight in companies that they have high conviction in, because I think at the end of the day, when we invest in an actively managed fund, we don't want to do something that's similar to an ETF, because we can easily just buy when markets open, we just buy the ETF. We want something that's different. We want something that can give us the additional kick, the alpha. And I think based on what we are seeing, based on the fund's holdings as of the end of March, it basically reinforces this point where they're not they're highly convicted manager, and as you can see, a lot of their largest overweights are basically how they position for their best ideas. Like a TAL education group is basically a function of them coming to terms that, hey, Chinese people are growing wealthier. They are willing to spend to make sure that their kids get the best tuition available, and these are some of the trends that they are seeing, and they are actually not afraid to actually pile their conviction in. And some goes for like things like Guizhou Multi. It's just a reflection of changing consumer habits and trends in how they want premium goods. And number two, of course, we can't forget about a track record. We need a fund with good track record, and I think based on what we have seen in terms of its return attribution, which basically strips apart how they allocate money to sectors and how they allocate money to particular securities. We see that a lot of the alpha actually comes from their stock picking. Yeah, and generally speaking, we always look at things from a risk-adjusted perspective, and we appreciate the fact that this fund has been able to achieve a Sharpe ratio of more than 1. So that means they are very efficient in terms of generating returns relative to the risk that they take. Yeah. And number three, I think when we look at Greater China, we like this fund because it has exposure to Chinese onshore equities, because we generally think that people are not paying too much attention to onshore Chinese equities. And from that perspective, I think it's still relatively quite cheap from a PE whether from a PE perspective, or is it from a market cap perspective relative to the rest of the world. And I think for this fund, in case anyone have any questions, they have about a maximum exposure about 20% to Chinese A shares. So it's not just so it's not fully a Chinese A share, but it has the ability to gain exposure to this market. And lastly, I think the third idea we have is basically Europe. As Colin has alluded to, we believe that a European revival could be underway. And some reasons to like Europe include, we think that there will be a strong rebound in economic activity. And number two, the looser EU fiscal policy could actually make growth greater than what we previously have thought. And number three, we think, generally speaking, with a potential uptick in growth, European equities could look undervalued relative to US moving forward. So the point about the looser EU fiscal policy is that they're no longer imposing fiscal austerity on member nations, which they have over the past decade, and instead they're moving more towards burden sharing of financial burden, and this we believe could be a game changer because it could allow greater financial integration, and this could actually boost economic growth and subsequently the company's return on invested capital. And for this particular idea, we recommend the BlackRock European Special Situations Fund. And before we go into the fund, I would just like to show you this data point that we are looking at. So this is basically the Google COVID-19 mobility report. So Google actually compiles all these report. They in a way, they track you, then they compile it and they see what is the percentage of change in visits to various places since COVID started. And as we can see, actually, the European nations have been able to close this gap that we have been seeing ever since lockdown started. And we believe this gap that they're closing could actually contribute to a stronger economic rebound than what people could be expecting. So just to move on to the product features. So why we like this fund, number one, is highly active and it's benchmark unconstrained. So benchmark unconstrained meaning that they don't care what let's say the Europe ETF is doing. They just do what they believe has the greatest value. And we believe that as Europe moves out from this post-COVID situation, it's important to actually look for companies that can survive this tumultuous period, and they can generate high cash flows, and that they have the proper balance sheet to actually survive this period. And that's what we think it's important, and that's what we like about this fund. So this portfolio manager, he's aware of the macro conditions out there, but he does not build his portfolio from that perspective. He just looks at the company. He just looks at how they're able to survive this period, and he builds his conviction from the bottom up. And we like this fund because it's aggressive. It can build high conviction weightings. And this fund may also invest opportunistically. So if they believe that this company, despite its beaten down valuations, if they can benefit from changes in corporate strategy, or if this company is restructuring its business and they believe that there's value in a world after they have done so, then they're not afraid to invest in this. So as you can see, this is the fund's performance year-to-date wise. And as you can see, the fund is pretty much close to break even. Whereas if you compare it to like a European stock index, which in this case is the Stocks Europe 600 index, it's still pretty much, I think, about 15% off its original value from the start of the year. And as you can see, we believe that the stock picking actually matters in a post-COVID world. And number two, I think the second thing we like about this fund is that it's basically, it has a multi-cap investment universe. So they can invest in small, big, and medium sized companies. And we expect this economic recovery, this potential economic recovery to benefit not just actually large companies, but also the small and mid-cap companies also. And in market conditions, right, this fund actually invests, I think, about 30 to 50% in small to mid-sized companies. But I think at this point, they're only about at the 25% mark. But I believe that as time goes on, as economic recovery improves, they will slowly allocate more towards these small and mid-sized companies. And we believe that these are the segments that can generate additional alpha for investors. And lastly, of course, it must have a good track record. And I think compared to all the actively managed funds that we have on the platform, this fund generally has a very good risk-adjusted return relative to its peers. And so over the past, these are an annualized 3-year return versus its maximum drawdown that you experienced so far. And we believe that with its investment mandate as well as a good track record, it will be a good product to actually consider when for your European exposure. So I think these are the key summaries of the ideas. Number one, a global comfortable bond fund, and this is largely to take into account the fat tail risk that we are seeing in the markets. Number two, Greater China, because we believe that China and Asia is expected to lead the world of this pandemic, and therefore we believe earnings to improve from this region first. And thirdly, I think for Europe, we have seen them with quite successful lockdown policies, and we believe with a united fiscal front, it could actually propel growth in the region. And we believe that you need a fund that can do a lot of things, especially in special situations like COVID-19, to actually take advantage of all these mispricings in the market. So that'll be all from me, and I'll be passing the time on to Wei Ren, who could share more with us some of his stocks and ETF ideas.
Hi, good evening, everyone. My name is Wei Ren. I am part of the Stocks and ETFs research team at FSM1. And today, the topic that I want to share with everyone is I wanted to share with everyone the investment opportunities in the post-COVID-19 world. But before I start, I just wanted to recap some of the ideas, the ETF ideas that we talked about at our Invest Expo at the start of the year. So if you were there for our Invest Expo earlier in January, then you would have heard about the 3 ETFs that we have actually recommended our investors to buy. So we recommended Environmental Protection ETF, the China Technology ETF, as well as the VanEck Factors Semiconductors ETF. And on a year-to-date basis, if you look at the performance of all these 3 different ETFs, these ETFs, they have actually done exceptionally well. And environmental protection especially, it is up by 53.6% year-to-date. And also the CQQQ ETF that we recommended, it has also been up by 42.6%. Now, all these 3 ETFs are a play on mega trends. And mega trends are actually your structural trends that are expected to shape our future. So if there is one lesson that we can all learn from this, it is that investing in mega trends, or also known as thematic investing, it can be profitable for our investment portfolios. And today my sharing is also a slight extension of that discussion on mega trends. And specifically, I want to talk about some of the mega trends that are brought about by COVID-19, and also what are some of the ways in which we can invest in these mega trends. So COVID-19 has been, I would say, an unprecedented crisis, and it has had a major impact on not just our own personal lifestyles, but also it has also impacted the way businesses conduct their business operations. So for most of us, during circuit breakers, when we stay at home, there are a couple of things that we probably have done a lot more of, one of which is, of course, online shopping. So we expect e-commerce adoption to continue to accelerate in the post-COVID-19 world. And on top of that, consumption of digital entertainment, including things like your streaming services, social media, that is also expected to increase as well. So these 2 things, we are probably quite familiar with it. But what is probably less familiar is probably the rise of digital health and wellness solutions. So things like your telemedicine, which in Singapore, I'm not sure if it's gaining traction, but in China, it definitely is, especially right at the start of the pandemic. Because if you have a very simple illness, you would just want to consult a doctor over a video conference on your phone, rather than visit the physical clinic and run the risk of contracting COVID-19. So adoption of telemedicine, it has been gaining traction in China. And I would suppose that in the post-COVID-19 world, people, in a bid to minimize contact with other people, they will adopt telemedicine solutions in the future in the post-COVID-19 world. As for businesses, being online, having an online presence is now not a luxury. It is in fact a necessity, or you run the risk of being put out of business. At the same time, companies are also having telecommuting arrangements. And in the post-COVID-19 world, even after the lifting of circuit breaker measures, companies, they will probably look at having some sort of a business continuity plan. And that also means that a part of the workforce will be permanently shifted to telecommuting. And for those people who are working in physical offices right now, there will definitely be some sort of a redesign of your physical workspaces. So things like your hot desking concepts are probably could disappear, given that employees need to feel safe when they go back to work in the physical office. So these are some of the trends and also the new normal that we could expect in the post-COVID-19 world. Now, there is one common denominator across all these different trends, and this common denominator is actually the increased adoption of digital technologies, which is actually the first thing that I want to talk about today in my presentation. Now, I think the first mega trend that you should watch out for in the post-COVID-19 world is actually the rise of the digital economy. Now, I think the digital economy is expected to play an important role. In fact, it has been playing an important role in our lives before COVID-19, but after COVID-19, it is becoming, I would say, it is expected to be a key part of our global economy. Now, the digital economy is a huge, it's very huge, and there is actually no universal definition to say what the digital economy entails. But we have broken down the digital economy into these 8 major sectors that includes e-commerce, e-services, e-travel, digital media. Right? Digital media will include things like your social media and streaming services, fintech, digital advertising, cloud services, as well as cybersecurity. And all these 8 different sectors, if you look at their market sizes, collectively, they are about a $9.5 trillion opportunity, which means that the digital economy right now, based on the sizes of all these 8 different sectors, the digital economy is actually worth about 9.5 trillion US dollars. And if the digital economy were a national economy on its own, it would actually be the 3rd largest economy in the world right now, just behind the US and China. So it is a massive economy and also a massive opportunity for investors. Now, if we look ahead into the next few years, there are actually a couple of factors that are expected to drive the growth of the digital economy. One of which is, of course, rising internet adoption. Now, if you look at the chart on the left, if you look at the internet penetration for areas such as North America and Europe, which are quite mature markets, internet penetration is actually relatively high and are considered close to saturation. But whereas if you look at markets like Asia and Africa, okay, that percentage is actually very low, and this represents significant upside potential for more internet users in the future. And China, okay, I want to highlight China here because China has the largest internet population in the world right now. But despite having the largest internet population in the world right now, its internet penetration in China is only about close to 60%, which means that a good 40% of the Chinese population, they are still, they still do not have access to the internet. So as the internet infrastructure in China improves, then we expect that penetration rate to pick up, and that also means a further upside potential for the digital economy to flourish in the future. And for those people who are already on the internet, okay, you can see from the chart on the right that these people who are already on the internet, they are spending increasing amounts of time on digital media. Over the past few years, it has been like that. And over the next few years, the average daily time spent is expected to pick up. Now, e-commerce, okay, it is also going to be a major part of our lifestyles. And this is also going to be a trend to look out for over the next few years. And by 2023, e-commerce is set to become a $6.5 trillion opportunity. And if you look at it in terms of its growth rate over the next 5 years, the global e-commerce market is actually expected to grow at about 16.6% annual growth rate. And this growth rate, by the way, it is actually estimates that is done by research firms before COVID-19 took place. But with COVID-19 right now, okay, this growth is expected to accelerate because a lot of people, they are going to adopt online shopping as part of their lifestyles in the post-COVID-19 world. Now, if you want to invest in e-commerce, then of course you have to look to China, because China right now, it is the largest e-commerce market in the world right now by revenue. And if you want to invest in the largest players in China's e-commerce market, then you have to look at Alibaba definitely, which dominates the market with more than 50% market share. JD.com and Pinduoduo, they are also some of the most common players in the e-commerce market. And collectively, these three players actually take up about close to 80% of China's e-commerce market. So if you want to invest in the upside potential of e-commerce in China, then you need to have these three companies inside your portfolio. Digital ads is also something that we should be looking out for, because this is a trend that has been accelerated by COVID-19. So a lot of businesses, they have to, there is a need for all businesses to now have an online presence. And also with consumers spending increasing amounts of time on the internet compared to your traditional media, businesses, they need to have digital advertising as part of their overall marketing strategy. Now, this market, it is expected to grow by 12% CAGR over the next 5 years. And by 2023, digital advertising is expected to make up about 60% of the global advertising market. And again, if you want to invest in this trend, then the question to ask is, who are the largest digital ad sellers in the world right now? Google and Facebook, they dominate the global digital ads market with combined market share of more than 50%. And over in China, you've got players like Alibaba, Baidu, and Tencent. Amazon is the number 4 digital ad seller in the world right now, which may be small compared to the kind of market share that Google and Facebook has. But Amazon is something to look out for, because Amazon, over the years, it has actually been gaining market share from the established players in the US. And of course, with consumers and businesses spending increasing amounts of time online, that also means that a lot of data is expected to be created on the digital space as well. Now, to give you an idea of how much data we actually generate on the digital space, okay, in 2019, the digital economy actually generated about 41 zettabytes of data. Okay, in my vocabulary, I only know megabytes and terabytes is probably the largest denomination of data that I can think of. So I actually have no idea how many zeros the zettabytes have, but to give you an idea of how much data that is, it will require 820 billion 50 gig Blu-ray discs to store all of that data that we generated in the digital space in 2019 alone, which means that the next year we will need another 820 billion Blu-ray discs, and in subsequent years as well, which means that our traditional data storage solutions has its limitations. Okay, which is why increasingly you're seeing that companies, they are shifting to cloud storage and cloud computing solutions to address their data storage solutions. And in this cloud computing market, a couple of key players. Okay, Amazon is currently leading the global cloud computing market with a market share of about 33%. Microsoft, with its Asia offering, it's currently at 18% market share. In fact, Microsoft, it has been gaining ground against Amazon over the past few years. So it has been doing relatively well on its cloud computing front. And also you've got Google and IBM as well, who are some of the key players in the global cloud computing market. And with data that is being generated, of course, security will also come into the picture, which also means that cybersecurity solutions, they are going to be part of a key part of the rise of the digital economy in the future. But unlike the previous industries that I've talked about, whereby there is a clear leader, The cybersecurity market actually is quite highly fragmented with no clear leader. But at this moment, the largest cybersecurity vendors are Cisco. Okay, if you look at this chart over here, Cisco, Palo Alto, and Fortinet. So these are currently the largest cybersecurity vendors. Okay, although I must say that there are some smaller players in the market right now, and the cybersecurity market is actually getting increasingly competitive, especially since a lot of the smaller players like Zscaler, Okta, and CrowdStrike Holdings, they have exploded onto the scene, and they have also been taking market share from the established players. And Symantec, with just a market share of 3.8%, it is actually also one of the market leaders. But Symantec, they have actually been losing market share over the years. Okay, they were once an established an entrenched player inside the cybersecurity market, but they were being disrupted by the newer and the more nimbler cybersecurity vendors. And right now, they have actually lost their number one position to other players like Cisco and Palo Alto. Okay, so if you are interested in investing in the digital economy, then the product that we want to recommend today is actually this ETF called the O-Shares Global Internet Giants ETF, because all the companies that I've mentioned in my previous slides, they are actually all inside this ETF. And one thing that we really like about this ETF is the way the portfolio is being constructed. So the portfolio is actually constructed using what we call a rules-based methodology. So basically, the portfolio manager of this ETF, it looks at two factors when deciding what companies goes into this particular ETF. So it looks at quality, okay, which is determined primarily by the cash burn rate. And it also looks at growth, which is measured by the revenue growth. So the portfolio of this O-Shares ETF, we call it OGIG in short, it actually consists of a good mix of large cap tech names, as well as the smaller companies that are expected to register very fast growth over the next few years. And if you look at the top 10 holdings inside this OGIG ETF, like I said just now, it's actually quite a good mix of big and small tech companies. So you've got the big players like Amazon, Alibaba, and Tencent. But if you look down the list, you'll see names like Meituan, Shopify, Pinduoduo, okay, and Zoom as well, which is the software that we're using today for this particular seminar. So this ETF has actually done quite well on a year-to-date basis, and you would expect that some of the main companies that are driving its performance are actually the large cap technology companies. But these are actually the top 6 companies that have been driving OGIG's performance on a year-to-date basis. Some of them are large caps, but if you take a closer look at some of these names over here, they are actually the smaller cap names in the market out there right now. So Amazon and Tencent are perhaps the most well-known names on this list here, and the others they are relatively well-known compared to the large cap names, and that's the beauty of investing in ETFs, because on our own, if we were to do our own research, there is no guarantee that we will be able to include all these stocks inside our portfolio, and some of them we've never even heard of. But if you invest in an ETF, then you actually get exposure to a portfolio, a diversified portfolio of stocks. Some of them may outperform and give your overall ETF performance a large boost, which is what we have seen over here for the OGIG ETF. Okay, so that is idea number 1. Idea number 2, I wanted to talk about China, because I think China has been recovering from COVID-19, and China is also something that has been talked about by my colleagues Colin and Sean. So I just wanted to echo their views also, because I think China has made very good progress since it reported its first case of COVID-19 at the start of this year. So at the start of this year, we're seeing thousands of new cases, but at this moment, the number of new cases in China, it is in double digits or just single digits on some days. And you can see also that sometime in June, we actually saw a second wave of COVID-19 I wouldn't say a second wave, but a sudden surge in COVID-19 cases in Beijing. So there's been a community transmission going on, a cluster going on over there. But if you look at some of the COVID-19 numbers over the past 1 to 2 weeks, I think so far they have managed to get it under control. And this is also in contrast to what you're seeing in the US right now, where you are seeing a sudden spike in COVID-19 cases. Some people call it the second wave, but there are also other people who call this a continuation of the first wave because Donald Trump and his administration never actually got to contain the first wave. So the picture is very different. So I would say that China has a very good COVID-19 containment strategy. And this is also showing up in its economy, whether be it in terms of its purchasing managers index, the PMI data, it has rebounded very sharply. Retail sales, industrial production, they have all showed recovery as well. And one thing that I'd like to highlight also is that the tourism industry, which is one of the industries that has been the hardest hit by the COVID-19 pandemic. If you look at the aviation industry since the start of COVID-19 crisis in China, then you'll see also that the air passenger volume has rebounded very strongly over the past few months. So this is something that we take heart in. And if China is able to prevent a second wave of infections from returning, then the recovery will eventually come. And there has been a rally in the onshore Chinese equity market in recent weeks. And if you read about some of the news out there, a lot of them, they are talking about a bubble forming in China. But I'd like to just point out and put things into perspective that the valuations of the Chinese equity market relative to the broader Asia region. Okay, at this moment, it is currently trading at about a slight discount compared to the MSCI Asia ex-Japan Index. And you contrast this to the 2015 situation. Okay, this was the 2015 crash when valuations actually rose to such high levels that the Chinese equity market was actually trading at more than a 50% premium compared to the overall Asia ex-Japan market. So from this perspective, are we in a bubble? I would say compared to the 2015, valuations are certainly undemanding despite the very recent rally in the Chinese equity market. And this is also backed by fundamentals because its economy has been recovering and it is also showing up in its various economic data points. Okay, so Sean has recommended a unit trust for everyone, but if you're looking for a passive vehicle, here's my recommendation. My recommendation is actually the Vanguard Total China Index ETF. And this particular ETF is actually designed to capture the performance of Chinese equities listed in and outside of China. And it gives you access to all major share classes in a single ETF, which means that in this particular ETF, you can find A shares, H shares, S chips, and N shares. Okay, China's equity market is a very complex market. Some of the existing products out there, they only give you 100% a pure play exposure to either the A shares market or the H shares market. But this product solves that problem because it gives you access to all major share classes within a single product. And some of the key companies in this ETF, I've listed it down on this particular slide. Okay, A shares will actually constitute a large part of this ETF. H shares is about 20%, and you also get exposure to all the rest of the other share classes as well. Okay, last but not least, a stock idea for everyone. So this particular stock idea, it not only benefits from the rise of the digital economy, it is also expected to benefit from the recovery in China's economy. So this company that I'd like to talk about today is actually Trip.com, which is the dominant player in China's OTA market, online travel agency market. So Trip.com was previously known as Ctrip, and it is the leading online travel agency in China right now with a market share of about 36.6%. The number two player, Qunar, has a market share of 16.5%, but this is also a brand that is operated by Trip.com. So if you include the market share of Trip.com and Qunar, then actually this company has, it actually controls more than half of China's online travel agency market. Now, just now I showed everyone the chart on a recovery in air travel. And I just want to say also that for China, it is, for China's travel industry, it is really more than just a short-term story. For me, this is more of a long-term story because I think, because if you look at the numbers, okay, Chinese tourists, they have increased by about fourfold over the past 10 years. Okay, but if you look at the number of Chinese residents who possess a passport, only 13% of Chinese residents actually have a passport, which means that as a population, the Chinese residents, they are relatively under-traveled compared to the more developed markets like US and the UK, where a larger portion of the population, they do have a passport. And is COVID-19 going to change air travel for good? Are people going to stay away from travel? Are people going to stay at home forever? I think that's the key question that we want to ask here for air travel, because I don't think people are going to stay indoors. Perhaps there will be some reconfiguration of seatings within the plane, but I think people still want to travel. I personally will want to go and travel after COVID-19 dies down. And if we look at the past crisis of the aviation industry, I think it's fair to say that the global air travel has been quite resilient in the past, especially with so many crises. And despite all that, air travel has been growing steadily over the years. So I think from this perspective, I would say it is unlikely for COVID-19 to do significant structural damage to the overall travel industry. And China's travel industry is currently on the recovery, and a lot of that is boosted by domestic travel. Now, another thing that we need to take note of is that there has been a paradigm shift to online travel bookings. China's travel market is a huge market, but 70% of travel bookings are currently made using offline channels. And which also means that in the future, as more people get access to internet and as more people are more educated and are more aware of the benefits of booking doing your travel bookings online, we are expected to see a shift of offline booking spilling over into the online channels. And as the leading player in China right now, I think Trip is expected to be one of the major beneficiaries. And one good thing about Trip also is that the share price hasn't rallied that much. So I think the opportunity is still there if you are looking for a stock to invest in. So, so that is all the ideas that I have to share with everyone. And if I were to summarize my key takeaways for today, it will be that COVID-19, I don't think it will go away, at least not in the second half of this year. I think COVID-19 will still be around. And what this also means is that the investment landscape is going to be quite volatile and challenging. But at the same time, it will also create new opportunities and areas for growth. And today, I think one of the things, or rather one of the trends, one of the mega trends that I have identified as a potential areas of growth is the digital economy. It is it is increasingly important, and this also means that investors, they need to have digital economy as part of their portfolios, whether they like it or not. And also China is something that we are monitoring. I think valuations are still at undemanding levels compared to the kind of valuations we're seeing over in the US equity market. So a continued recovery in the economy also means further upside ahead for the equity market. And if you want to have a stock idea that benefits not just from the digital economy, but also from China's recovery, then I think Trip.com is a stock that you might want to take a closer look at. Okay, so with this, I think that concludes the presentation for the three presenters today.
With this, we actually come to the end of our presentation for the FSM1.com mid-year outlook. Thank you for taking your time to join us here today and for staying attentive throughout this webinar. But we hope that we provide you guys a clearer picture of what to expect in the second half of this year. The upcoming events will continue to provide you guys with more market updates as well as exciting ideas to profit on. So do stay tuned to all these upcoming events. Thank you.